Hello, everybody, and thank you for joining the FX London Open Breakfast. It's very nice of you guys to join me on the last trading day of the week and non-farm payrolls Friday as well. What an exciting week, as always. Let's have just a quick roundup, really, of kind of where we are in the market. So yesterday we had ECB cut, China cut unexpectedly, and also, of course, extra QE by the Bank of England. Now, all of that has huge implications. Like when you get those huge, big central banks cutting at the same time or doing some form of easing at the same time, that means something. But however, how we've seen, we've seen gains be quite short-lived. Obviously, the euro was sold off immediately. That was kind of interesting. We saw a better than expected Aussie. Or very strong Aussie reaction, positive Aussie reaction to the China cut, as one would expect. However, there is a little bit of kind of differentiation going. As we move into payrolls, we are slipping a little bit. The stock market's just opened. They are lower. But there's just one thing before I look at some charts in more detail that I'd like to just kind of discuss with you guys. And it's really that, yes, we saw the euro fall very, very sharply yesterday. In fact, it's still falling this morning. It's just broken a new low now. And we saw, obviously the pound didn't do particularly well either. There does seem to be a bit of differentiation in the markets now between those economies that are kind of mired in recession, austerity-induced recession, and those countries that could potentially do quite well, that don't have the same public finance issues, that don't have the same growth worries as such, between basically those that are on weak foundations and those that are on strong foundations. And the ones on weak foundations are your euro, your sterling, your yen. Your dollar is kind of to the side of that because of, and yen as well, I suppose, in some ways because of its safe haven status. But certainly there you've got, euro and sterling as being quite weak currencies at the moment. And then on the more kind of less shaky side of things, you've got your Nordic currencies, your emerging market currencies, your Aussie, your Kiwi, your CAD. All of those things are going to be quite important. So, it's just worth kind of looking at that even stimulating, like monetary stimulus is having less of an effect on markets, and also isn't really going to bolster economies. Isn't really going to bolster economies that are going through kind of austerity-induced recession. Okay, guys, let's get onto the charts very, very quickly. Hang on, bear with me one moment. Now, what should we start with? Shall we start with the euro? Let's do it. And I will cover someone else, and it's probably going to have to wait a little patiently. I've talked about gold, but I will talk about gold, and I will do that very, very quickly. Okay, let's take a look at this euro chart. As you can see, kind of sharp move lower, stuck in a range, but really, even after that EU summit last week, unable to break above that kind of 127.50 level, but even 126.70, not even able to get up to 127. That does suggest weakness, and obviously kind of 126.70 is the 50-day moving average. That seems to be capping the upside. The downside, well, we are getting to quite an important level here now. Obviously kind of 123.20, then 122.60. That was the low from, 122.88 it says here, was the low on the 6th of the 1st of June this year. So, that's obviously in sight now, and that is your next major support zone. We believe we may drift lower into payrolls. That seems to be kind of where the markets are going right now. Obviously, they weren't too impressed by that global liquidity push, largely because they don't know how that's going to impact growth. Is that going to stimulate growth and confidence in the Eurozone in particular? We just don't know. So, there's a limit to monetary policy, and I think the markets reflected that yesterday. On the other hand, payrolls do tend to be quite important. They're more of a hard fact, rather than, where you are with payrolls. With something like monetary policy, it's a bit difficult sometimes to see what are the impact for economies down the line. So payrolls, I'll give you a quick rundown of what we expect. We are looking for a figure of 175. So we have an econometric model here, and plugging in all our inputs, we're looking for 175. The market right now is looking for 80. So what are the kind of, what can you expect? Well, we think a reading of 175 would be a big recovery from the May figure of 69,000, which was a big disappointment. We believe that would cause a rally potentially in risk, certainly a knee-jerk rally in risk. That's what we would expect. Now, looking back over the last couple of months with payrolls, we've actually seen the impact on the markets have been quite muted, really. They've been very short-lived as the Eurozone crisis has taken over. But if the Eurozone crisis is stable, even just more stable than it was kind of 3 or 4 weeks ago, then potentially we could see payrolls having a bigger impact. If you get a very strong payrolls number, well, what does that mean? Number one, it means that the US economy is possibly doing quite well. That would be good news for the commodity currencies, the CAD in particular, the Aussie, the emerging market currencies for sure. It would be good for stocks. What would it mean for euro, dollar, and cable? Well, interestingly, we think they could rally to start with. However, we think the rallies could fade because it would mean in the longer term that there'd be less likely chance of QE from the Federal Reserve. So, looking at where we are now, let me just go to a shorter term chart. Just bear with me one moment. All right, so this here is just the 35-day chart of euro dollar. So as you can see, we got that weak payrolls number last week, where we saw a bit of kind of whipsaw action. However, then we started to kind of move higher as expectations built about a positive result from the Greek election and also this EU summit. Since then, obviously, we've come off quite sharply. So again, in terms of support and resistance, a very weak number, and we think it would have a knee-jerk reaction of causing a flood to safe havens coming out of risky assets, and you would consider the euro a risky asset at this stage. So we could see a decline back towards that 123 mark. Now, remember, back in June, the markets didn't really like it below 123. However, we have got kind of to another stage now whereby we've gone past that EU summit. We've gone past those Greek elections. Nothing really has been done. I think the EU has certainly bought themselves some time. But, that the economic and the political picture both point to a weak euro in my mind. So we could easily get below 123 this time. Obviously, then, you've got your 122.80s, but then you're really looking at 120, and then that low from June 2010. Which was below 120, so when we went all the way down to, or April 2010, sorry, I should say, went all the way down to 118. So, these are the levels that you're looking at. Right now, the next key level to watch is that 123 level. You've got 123.20, then 123, another breach of that. But as I said, economic and political outlook really does suggest, a weak euro in our view. Now, on the upside, as you can see, obviously, 124.50 has been a massive level will be a massive level of resistance. Not only is it a whole number, but it was also a bit of a resting spot here, kind of late last month. So prior to that EU summit, and what we've really seen is it kind of a sharp move higher post EU summit, and then completely taking that away. So the ECB, they were quite aggressive cutting stance whereby they cut not only interest rates by 25 basis points, but also kind of market-based rates. So the deposit rates that banks get paid to put their money into the ECB was cut to zero to try and stimulate lending there. Well, the markets reacted to that as like a massive kind of slashing of yield for the euro. Hence, we saw this big crash lower. A big figure and a half lower here, so kind of 120 pip move lower. So what we're seeing is, what we could see potentially is that a good number does cause a bit of a mini rally, but we do think 124.50 would probably be enough. And we still think, however, that, in the longer term, we're looking for a weak euro because you essentially have this situation whereby if you get a good number, it means that the Fed's not going to do more QE, and that is kind of dollar positive in the medium term for sure. Let's also look at sterling now as well. I'm going to look at it in exactly the same way to give you these support resistance levels. Just bear with me 1 minute. I'm going to have to just change my view. Great. You should be able to now see cable. I'm looking at my Bloomberg charts, guys. I'm sorry about that, but my other charts are a bit funny at the moment. I'll move on to them in a minute, but they don't seem to like cable and euro, which is rather frustrating. As you can see, a bit more further downside we could get in cable here. So this is, again, your 35-day chart. This is what happened at the previous payroll. So in the May payrolls, which was early June, whipsaw central. So do watch out for that today. when you get payrolls, it can sometimes be complete whipsaw as the market doesn't really know which way to go. But overall, kind of it moved in the same direction as the euro in the end. I mean, it kind of rallied a little bit up, all the way up to that 158. But it is, over the past month, it's moved really in a 153, sorry, to 158 range. That's quite a wide range, really. But again, whipsaw, we wouldn't be surprised, especially since we've seen such a big move. However, what about the overall long-term direction? Again, the UK economy is weak. The Bank of England are, stimulating the economy. However, on the other side of that, you've also got the fact that the pound is attracting safe haven flows away from Europe. Now, that is going to have less of an effect on cable, but it is having an effect on euro sterling. So that's really what I believe accounts for that residual strength in sterling, because it's certainly not the economic performance in the UK, which is pretty dire. Those of us here in the UK can probably do. So again, let me just circle that, because it's such a nasty little move, and it's why kind of we like to keep away. But that is some, that is some whipsaw action there post that payrolls data, and that was purely caused by payrolls. We saw a sharp move lower and then a bit of a spike higher again, and then kind of sideways movement. So if we get a number in line today, so roughly around kind of maybe the 90, 110, 120, again, bit of whipsaw action, but we may just move sideways. Kind of a bit like last month, what we saw there was this 69 figure. It's like, well, it's pretty bad, but maybe it's not as bad as some would have thought. Maybe it's, it could, it's not dire. The US isn't losing jobs. It's not creating many either, but it's kind of, it's kind of, not yet enough to cause a concern. If we get another weak reading today, we think that would cause a concern, and then we could see risk really sell off. So looking at cable, obviously 155, massive support here. Look at that. All the way back, this month, 155 has acted as great support. Below there, you're really looking at a move towards kind of 154.50 and then potentially to 154. Now, that's if we get kind of another weak number, because people are going to worry then that 2 weak months in a row, that's looking even worse. Oh, my God, things are going to go wrong. That would be our knee-jerk reaction. We could see kind of a 50 pip, maybe 100 pip move even to the downside. However, then, of course, we would be scouring to listen to what the Fed was saying, and there could be then some QE expectations that may push things up. But, however, what we've seen is that, right now, in this current environment, QE expectations aren't really doing much for the markets. What we certainly didn't see risk rally yesterday on the back of, greater liquidity or looser monetary policy in Europe, the UK, and China together. Maybe that's because the markets are waiting for the US, but I've got a kind of a residual feeling that maybe it's because people think, actually, what is going to be great? What is going to be good about more QE? Is it really going to do anything? Is there not a limit to what they can do? And that's actually going to kind of potentially weigh on kind of your riskier assets, like your cable, like your euro, and potentially could even weigh on kind of the Aussie as well. If we don't move into in a weak growth environment, we may look at more relative fundamentals. So you can kind of almost then scratch that about, the Aussie being under pressure. The Aussie will be under pressure and risk on, risk off. But in a kind of an overall low growth environment, the Aussie should outperform things like the euro and sterling because their relative economic fundamentals are better. Likewise for the CAD, likewise for the NOK and the Stocky. So these Nordic currencies should do fairly well. But as I said, do watch out on the downside if we get another weak number, 155. Now, we're not predicting that. We're predicting a strong number, as I said, 175. What does that mean? Well, that to me suggests 156. However, as I said, going forward again, a stronger number really could, it could put the US up there as, the country to be in because there is growth there. There would be less chance of QE, that type of thing. So you could potentially see the dollar start to do well, and for cable to kind of end up being a little bit range bound in that environment. But again, as you can see, we can see our longer term range 153 to 158. Our shorter term range, as I said, 155 first support, second support 154 ahead of 154.50 ahead of 154. And then you've got 156 as your immediate resistance level. But then, of course, you've got your 157 to 158. Quite easy, really, to trade, to look at these ranges in sterling at the moment. Now, let's just take a look. Sorry, just bear with me one moment. I'm just going to take you off the camera and then pull up another way of looking at this. This is just your daily Ichimoku cloud. And again, this is, we're coming to the kind of the bottom of the range, but it does look like we're still, let me just draw a line here. It does look like we're still on a nice upward channel. If we can hold above kind of 153, or even, sorry, not 153, like 155-ish, 155, 30, 40, if we can close above there today. So currently we are below there at 155.10, but this kind of 155 area is really important, because if we can hold above there, then we may kind of spring higher. But obviously, whether or not we do or not will depend on payrolls. So weak payrolls, we could get through there, could get a week close below there, strong payrolls number, and we could bounce up. We may be able to spend another week above this kind of mini, or 6-week long, uptrend. So what do I think of Aussie dollar? Someone's just asked. Aussie dollar is an interesting one. I'm just going to show you that now. Just bear with me one moment. I'm going to change my charts, because my Aussie charts are working on my other charting package. Bear with me. Okay, let's take a look. So this is Aussie. Aussie had a really nice kind of climb higher, really, the last few days. It broke out at the top of its most recent range, which had been a bit of a double top there at 102.20. That was a massive level. Didn't manage to hold on to gains above 103, and right now it's back testing support at kind of 102. 60, 70, around that area. That's a major support zone. It had been previous resistance, now it's support, but it's getting very stuck around that level between kind of 102.70 to 103.20. That's a kind of a key level, and really, really important where we close today, I think, on the week. If we get to close kind of within this area, so maybe towards 103, then it may mean extending gains. What's a very bullish sign, I think, is if we close above 103.20. To do that, we think we're going to need a very good payrolls number. Now, usually people think good payrolls numbers about 200,000 a month. However, I would argue that that in this current environment, 175, as we predict, would be enough, really, or would be enough, really, to really cause that to cause the markets to rally and risk to rally. So above here, where are we looking? Well, you can see kind of 104.70 to 105. There's not much in the way there. So again, if we get a really strong weekly close, we could get back towards that 105 level. However, a week close could see us back down to that 102.20 level, or just kind of 102 to 102.20, and then all the way down to kind of below 101. So to kind of down to that kind of 100.5. So let's look on a shorter term time frame as well, to just figure out what's kind of going on here. So in the short term, as you can see, that nice move high that we had, kind of at the post that payrolls and post that EU summit, really did give some, nice big boost to Aussie, which had kind of declining really sideways. Now we're back to that sideways movement, and as I said again, we've got to get above that 103.20 level to be able to extend gains here and to really get some power behind that move. But as I said, there are some residual signs that maybe the markets are moving from risk on, risk off, all the way back to potential, all the way back to kind of more of a potential look at more of a potential kind of relative economic fundamentals, relative economic fundamentals, relative fiscal positions, and that is positive for dollar. Now, someone's asked a great question. Can I look at dollar CAD? I will in one moment, but I'm going to ask. There's one guy who's been so patient. I'm going to look at gold right now, and then I will go to dollar CAD. I promise. So this is gold. So as you can see, gold moving with overall risk appetite as it does. When you get, I think yesterday that cut by China, Europe, and the UK. It wasn't really seen as being, oh, hey, that's positive because we're boosting, we're boosting global monetary policy, which in fairness, some of us thought would end up like that. But I think it was more a sign, it's caused actually a sign of, concern about global growth outlook. And right now, remember, China also cut rates back in June. And when they did that, that was the first time in kind of 3 years. That was a big move. And that didn't really have too much of an impact on the economic data in China. And it's likely that their June data, and we get a raft of June data coming out of China next week is probably quite weak. Now, someone's just asked me about this chart, so I'll go through what it all means in a mo. Let me just put in as well. Hang on a minute. I want to put in the RSI. Sorry, I took that off yesterday because I was doing some chart work myself, but back on now, which is good. So gold, as you can see, hourly, moving into oversold territory really, finding some very good support here at just below 1600 at 1595. But the reason why gold doesn't do well is that until growth is back up, until we get kind of stronger growth, there's going to be a fear of there's going to be the fear of or there's always going to be the fear then of some of deflation. And remember, gold is an inflation hedge, so when there's deflation around, gold doesn't perform well. 1600 major level. If we close below, or say 1595 major level, which is your 200-hour moving average, if we close down there, then we could potentially see the potential for more declines down to that 1570 level. But we are starting to move into slightly oversold territory around about that 33 level now. Remember, anything below 30 on the RSI is oversold. So do watch out for that. Looking at it just from a much shorter time frame, again, kind of still actually, declining a bit. So we could have a bit further to go. As I said, we could get down to that 1590, maybe even down to 1570 level. Looking at it from a longer term chart, still very much stuck in a range. 1550 is your downside, just below 1650, so kind of 1640 is your upside. So we're really range bound at the moment because the markets don't really know how to accept it. Usually when you get even though unofficially coordinated policy loosening by the world's biggest central banks, you actually tend to see risky assets rally and things like gold rally. And we've certainly seen that in the past, but not when there's such major growth fears right now. So, maybe if we would get more QE, maybe that's what it is. Maybe the market wants more QE from the Federal Reserve. So they're saying, right, we're going to hold out until the big boys start the printing presses. And obviously, if they don't, then that could ruin things. But remember, there are a lot of problems that QE can't fix at the moment. So it could just be a sign that we're in for kind of maybe another couple of quarters of weak economic growth, and that's really being factored in now to gold. Because remember, gold and stocks as well, they tend to price things about 6 months in advance. So things aren't looking fantastic into the end of this year. We've still got a lot of austerity. We've got that fiscal cliff in the US. We've got weak corporate earnings and potentially so we could potentially see some further declines here. If obviously, the markets are expecting some further weakness in the overall economic outlook. Gold is a great proxy right now for growth expectations. Growth expectations are kind of fairly weak, and hence why, on a longer term basis, we've really fallen quite drastically. Someone's just asking, what are my moving averages? Well, the blue one is on the 21-day, the green one is 55, the yellow one is 100, and the red one is 200, and that's the same across all my charts. I don't really look at them on 5-day, 21-day or 21 period is my lowest, and that sometimes it's down to kind of what you grew up with, what and it's also just kind of what works for you, and for me, I like a 200. So I have a mixture. I tend to look at simple moving averages, but I'm not averse to an exponential moving average either, because I think by and large they're kind of the same thing. There is slight differences to them. The exponential moving average, what's good about that is you get it going back a very long time, so you get to see it kind of continually rolling, can be a little bit smoother. But overall, a simple moving average smooths things out for me too. Okay, someone's asked about CAD. Let's take a look at that because that's important. This is dollar CAD. So as you can see, dollar CAD very much stuck in a range. CAD has been, it's been fairly strongish this week. It had this is dollar CAD, remember, so it's the dollar against the CAD. So when this is falling, it suggests that the CAD is strengthening versus the dollar. So the CAD actually reacted quite well to yesterday's China data, hence why we got that sharp move lower in dollar CAD. However, we did manage to find some very good support here at the 55-day moving average, around kind of just above 101.50. We do think we're going to get back down to parity again, because we could do it even quicker, largely because of if we get a strong payrolls number today, that would be good news for the Canadian dollar. So one thing I would say is that, in the past, what we've seen in the past is that even though the dollar, the CAD actually does really well when the U.S. economy is doing well. And so dollar CAD, the dollar against the CAD, can be a bit of a casualty when you get a strong payrolls number. So again, as I said, that kind of 101, 40, 50-ish, that's acting as really good support. And then below there, you've got 101, and then 100.50 ahead of parity. So some major support zones on the way down. Could be a little bit sticky, but we could be then kind of moving to a new paradigm whereby, a new kind of level for this pair, whereby we kind of move back into kind of this range, the lower of this range, which is life below parity to dollar CAD. And again, a strong payrolls number would make that even more likely. But added to that, of course, it did react quite well, a bit like the Aussie did, really, to the better payrolls, to the loosening of the Chinese monetary policy. Couple that with a strong payrolls number today, as we expect, and you could see a nice move higher in the CAD. Looking at it from a kind of using the RSI just as these kind of momentum indicators, they can be a bit lagging, but overall, they're really moving. It's really kind of moving sideways a little bit. So we could drift into payrolls and then react to the payroll number. So whereas we do seem to be kind of drifting a little bit in quite a tight range, really. The markets aren't willing to push it below this major support zone here at kind of 101.40 to 50. We're going to have to wait for payrolls for that. Just looking at it as well on a very short-term basis, again, kind of flatlining really just today, and that's very normal. This is total pre-payrolls. Very normal to have it kind of flatline. But as I said, a weak number could be bad for the CAD. We could see the dollar do better. We'd probably look to be buyers around that kind of 102, 10, 20, because you don't want to get caught up in the whipsaw action. So if you get a very weak number, people might start worrying. That could put inflows into the dollar. So we'd probably buy around about that kind of 102 level, because we think above there could suggest a stronger recovery for dollar CAD. And likewise, we'd probably be kind of sellers around about the kind of 101, 10, 20 level, because then again, that may cover you for your whipsaw, your kind of 100 pip whipsaw action, and then we could potentially extend declines back towards that 101 level, back to kind of parity. Okay, in general, is good NFP dollar positive and euro negative and vice versa? Well, it's interesting because in the short term, you could say that a good non-farm payrolls number is very strong, good for risky assets and bad for safe haven. So in the short term, that should be, the euro may bounce higher, the dollar may come off a little bit because people are less worried about the overall risk environment. However, in the more medium term, take out kind of the first few days trading, you may get so after that, then you may actually get people reassessing the likelihood of more QE from the Fed, and so we could actually see the dollar do quite well. So the immediate knee-jerk reaction in a good, strong NFP number, like around about the 175 as we're predicting, could be a move towards a move higher, potentially maybe above 124 in euro dollar. But then we think it's going to actually kind of meander lower as kind of the dollar gains from its better economic position. And really, economically and politically, as I said, we're still looking for a euro dollar. So we think short, sharp bursts of strength in euro, but overall the trend is still lower. And that's, since losing that kind of 125 handle yesterday, we do think now that the way is open for a test of that kind of below 122. Okay, everyone. I think that's it from me, really. I've come to the end of my time slot. But good luck trading today. Obviously, payrolls is a great day. Do enjoy it. And thanks so much for joining. I know that I'm going to be missing a few of these in the next kind of week or so, because I've got a few kind of holiday days and whatever else. But what we do, I'm definitely not. I don't think I'm going to be doing one. In fact, I'm not 100% sure. But anyway, we'll find out, and I'm sure there's no. So next Monday and Friday I'm here. Next Wednesday I'm not. And yeah, exactly. That sounds good. Great. Okay, everybody. Thanks so much, everyone. Bye-bye.